I'm Chris Preston.
I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history, the illustrious history of Cabot Wealth Network. Coming to you as always from Madison Avenue Studios here in Arizona and Vermont. Brad, before we get to market talk, big weekend for my beloved Buffalo Bills against their arch nemesis, Kansas City Chiefs. They have not. They're 0 for 3 in the playoffs against Patrick Mahomes. Um, it feels like it's their due, but I don't know. The Bills' entire
So,
history is working against them.
did you watch Mad Men by any
Yeah,
chance?
of course.
Okay. So, Draper is in an elevator at one point, and somebody's complaining to him about like how he ruined his life. When you called the Chiefs the Bills' rivals, my take from the Chiefs' perspective is sort of a we don't think of you at all.
Yeah, exactly. Yeah, I remember that
Yeah.
line. Yeah,
So
no, I mean the Bills have beat them in the regular season every year, including this year. But playoffs are
cool.
when it matters,
Do,
and they've lost.
do they have like a mini Lombardi trophy for when you win in the regular season, or is that doesn't
Yeah,
count?
yeah.
No,
I guess
it
it's sort of like when Rex Ryan was coaching the Jets and they'd go up against the Patriots and he'd boast and they would beat them maybe occasionally, but the Patriots would win when it would matter. It's maybe a little
yeah,
bit like that. I
yeah.
mean, Bills are way less obnoxious than that, but yeah.
It's like being like a U of A football fan where it's like, oh, here comes Oregon. It's like, well, or here came Oregon back when the Pac-10 and Pac-12 still existed.
Yeah.
But it was like, oh, we consider them our rivals. It's like, no, they're Oregon. They don't care about U of A. Like
Right.
they'll probably win, but maybe not. I don't know. It's being an underdog fan is not the best thing in the world.
Yeah. Well,
Anyway, rip
like to pay
rip the
off.
Bills, Chiefs, Eagles Super Bowl. I'm calling it now.
I mean, Chiefs Eagles. I can't think of anything worse than Chiefs Eagles Super Bowl. This, one team I'm tired of, one team who I just
Is
despise.
gonna throw batteries at you.
Right, exactly. I think a lot of America is rooting for Bills Commanders. My brother-in-law is a huge Commanders fan. He said, this is sad. He's a Washington sports fan. He said last week's Commanders win was his number one sports moment ever. He's almost 40. And
Yeah,
wow, that's a sad thought, but I guess that's true. Too young for
yeah,
maybe some of the Redskins heyday in the 80s. So anyway,
I get
uh,
it.
yeah,
Long-suffering Arizona fan, I get it. Other
yeah.
than like the '01 World Series, we got nothing. So,
Right. Yeah. Okay, let's move on to investing. Tell people what we're going to talk about today.
so this week we are going to be joined in the second half of the show by Mike Larson of MoneyShow. He's going to talk about his investing strategy and a top picks report, for which some Cabot analysts were contributors. We are going to talk about the bull market. It is fully back. We're going to talk about Netflix earnings. Stock rose 13%, I think, in the one day after earnings, just a blowout quarter from them. And we're going to talk about airlines.
And before that, as always, we'll do defend the take. And it's your turn this week, Brad, for which you have 90 seconds. And your take is that the S&P will have a 10% correction at some point this year. Go.
So this is maybe a little bit of a cop out, and the reason for it is it's a 50-50 proposition. Going back to like 2001, it's been just over 50% of the years that we have had a 10% correction in the S&P 500. Last year, we did not get one. Obviously, we had one in 2023. 2022 was a bear market. So the reason that I bring it up though is it it would really help address some of the valuation concerns. Um, every statistic you look at, whether it's like Schiller PE, whether it's traditional PE, whether it's Buffett indicator, everything is overvalued right now. And the two fixes to high valuation are better earnings and basically time, right? So either your earnings growth rate can grow a lot. So, a stock that's trading at 20 times PE, if earnings double, it's now trading at a 10 times PE. Well, we need a little bit of a correction, a little bit more than we got last year. We saw a bunch of 5% corrections in the S&P 500. A 10% correction this year would buy time You've got the devaluation from a 10% decline, but then the recovery from that decline also buys what is at least half a quarter, possibly a full quarter for the value for the earnings to catch up to the valuations. The market needs a little bit of a breather. It'll get the bears sort of off our backs, or off your backs, maybe is more a more appropriate way for me to say it. Um, but it's not going to put the bull market at risk, I don't think. For the time being, it's green lights everywhere. Everything looks super, but we need a breather.
All right, even slightly over, but not too much. Um, I agree. I think we'll get a 10% correction. I think I even said at our, New Year's or end of year predictions episode or whatever. I think stocks will be up another 10%. Maybe not, probably not 20, at least not in the major indexes, S&P, NASDAQ. I'd say 10% this year, but that we'll get a significant pullback. Like you said, we had some, we did come close to 10% in the S&P last year's over 8% in late July, early August. NASDAQ was over 10%, it was 13, 14%, but S&P did not get there. So I think you're right that we need sort of a re-rating of sorts. Felt like we might be on our way there. What did we get to? 4.5,
Something like
5%
that.
at most, maybe 5% intraday. Pullback just now in December and January. But that quickly has turned around, which is a good way to transition to number one in our big three. The market is back at all-time highs.
Yes, before we move on, I just want to hit one last thing, which is we saw some really quick sentiment shifts at the end of the year. We went from, investors' intelligence at like a 4 overbought, immediately back to a 1. That kind of whipsawing sentiment would be well served by a little bit of sustained selling, not enough to take the legs out from under the market, but enough to reset expectations a bit. But
Yeah.
like you said, let's move on. Bull market's back, baby.
Morgan's back. I mean, we sat here 2 weeks ago. I think we had Mike Santolo on. And Mike, is a growth investor, but tends to be a little cautious when he's seeing signs of a pullback. And he had seen it. He looks at the under the surface stuff. He has some market indicators, Cabot tides, that sort of take the temperature of what's actually going on in the market. And he saw, the number of new lows, sorry, number of 50 new 52-week lows in the market exceeded 300 as recently as, I mean, when he was on our episode 2 weeks ago. I think even more recent than that, maybe like 10 days ago, 11 days ago. Um, and not there weren't many stocks making new highs. Well, now it's completely flipped. There's like 50 stocks at 52-week lows and more than double that at 52-week highs. Like I said, market is back to new all-time highs. At least in the headline indexes. Small caps have some recovering to do. I don't know if the Dow's quite at new highs,
No.
but amazing what we're back at the mercy of the Fed. We thought we'd wriggled free of that. Maybe at least when they did their 50 basis point cut last September. Like, okay, now Fed has turned to friend, not foe, and did for a little bit, and then as they clearly pumped the brakes, worried about inflation again, that prompted the pullback in December and January, at least partly prompted, along with Treasury yields spiking. But just one decent or slightly cooler than expected inflation report, two actually last week, PPI, CPI. This flipped the script and confidence is back. Trump taking over this week and not issuing tariffs. I think that's been a big one,
Yeah.
the rally this week, especially on China. So I think those have all combined to restore confidence in the market.
Yeah, definitely. The note that I have underlined right now is just textbook. Looking at the bounce back from a technical standpoint, I we had talked about the bull market being back internally at the beginning of the week, and then yesterday I was like, I don't love that or 2 days ago, I was like, I don't love that we haven't hit new all-time highs or that we haven't been able to hold all-time highs. We were in like this downtrending channel from December 6th through essentially Monday of this or Tuesday of this week, I should say, broke out of that channel, broke back up over the 50-day moving average, and then we tagged new all-time highs once on Wednesday. Yesterday we set new all-time highs, and today we appear to be holding them. My guess is with it being the end of the week, we probably close near that like 6,100 level on the S&P, but it is what I would consider a textbook breakout, full steam ahead. The risk assets, the stuff I think we've talked about it on this show. I think I've definitely written about it, but some of the high risk stuff like space, quantum computers, Bitcoin, the stuff where like the most high risk investors are putting the most of their money, that stuff's all rallying. Space popped really, really nicely on Trump's announcement that we're going to Mars. ASTS was an early leader. They took a little bit of a hit from a convertible offering, but they are bouncing back right now. Quantum stocks are coming back from their Jensen Huang induced sell-off. Bitcoin's right at the top of its channel at like 106 right now. I keep waiting for that to break out. That's like my only risk measure that is not overperforming right now is
Yep.
Bitcoin is still range bound. If that breaks out, that's a euphoria market to me. And I think
Yeah.
is probably the contrarian in me is like, we should probably be careful if that happens. But right
Yeah,
now,
I think we're in a
everything's
good
great.
spot. Yeah, we're in a good spot now. Hard to go from uh as bleak might be too strong a word. As downtrodden as the market seemed 2 weeks ago to complete euphoria this quickly, and I don't think it has. One thing that probably helped contribute to this week's rally, Netflix reported uh, another amazing quarter, 102% earnings per share growth, 16% subscriber growth, 18.9 million new subscribers, a record. Uh, Clearly their pivot to live sports had a lot to do with that. It had, their first NFL games on Christmas Day. They had two games that led to a lot of subscriber growth. That's the one. There was their one blind spot. A lot of other streamers have live sports. Amazon, like you can get like all the TNT, TBS type sports on Max. The Turner Sports on Max, and Apple has had baseball at least, maybe hockey too. I can't remember, but anyway, NFL, and then the Tyson Jake Paul fight from what's that November was a huge hit, and now they're also at a WWE. So Netflix just seems to be getting even stronger. The pivot to live sports seems to be they're now going full steam ahead and making their one blind spot a potential strength.
Yeah, I don't want to throw my shoulder out, and Chris, I think you can probably join me with this in patting ourselves on the back on this. But you and I
No,
were,
let's do it.
yeah,
Yeah. What other podcast admits its faults by consuming copious amounts of hot sauce? We should pat ourselves on the back when we have a chance. So yeah,
yeah.
go ahead.
So we both had Netflix early last year, middle of last year as our best pick through the end of the year. Um,
I
Stock
think that
was
was of the
great.
Mag 7, wasn't it?
Yeah, it was like
Yeah.
of all the Mag 7 stocks, the one that we like most is Netflix. And as far as I'm aware, they've been the best for performing. I don't think it's close either. I should have maybe looked that up before we started recording, but
Well, they're up
uh,
six in the last 6 months, up 52% and 98% in the last year.
yeah, so they are killing it. I will say, if you had told me immediately after the Paul Logan fight that Netflix was going to have a record-setting quarter, add record numbers of subscribers, I would have been really impressed because that was kind of a mess.
Yeah,
But
but people are already there at that point. They've once they're there, you know,
their NFL games seem to have gone off without a hitch, technically speaking. I mean, like you didn't have any of the social media complaints about lag, about unable to connect, about any of that stuff. So
right.
it seems like they took away the exact right lesson from Tyson Paul when it comes to live streaming, which is I don't know, backup servers, whatever technical fixes they implemented, or maybe it's just that was such a high profile fight that it didn't match what their expectations were for the NFL games. Uh, the one thing to be aware of with Netflix on the heels of this is their last quarter where they're going to report subscriber book growth. Um, so we're going to lose a little bit of visibility and granularity into it, but subscriber growth, like absent price growth or people pivoting from ad-supported tiers to like paid tiers, you can sort of suss out what subscribers numbers look like from profitability. Like
Yeah.
if their margins are dropping and their profits are dropping, it's like, okay, well, their subscribers are probably dropping. So not reading too much into it. Great quarter from Netflix. I don't know how much it contributed to the overall rally, but it was certainly, it feels like maybe the cherry on top more than like part of the Sunday.
Right. Yeah. I don't think it has Nvidia like influence on the market. Maybe only Nvidia does at this point, but yeah, it's certainly from a perception standpoint, it probably helped. This was billed as a strong earnings season, and Netflix having banks kicking things off with strong earnings, and then followed by Netflix is a good sign. Speaking of strong earnings, airlines, that was one of my hot spots that I picked last week for this upcoming earnings season. All came out with pretty good earnings in the last few days. A couple, namely American Airlines, had disappointing guidance, fell below expectations, so the stock pulled back a bit. Like United had very strong earnings growth. I have it right here. This 8% revenue growth year over year, and EPS growth was 64%, and both way ahead of estimates. Um, and it all just points to the strength. I know you have numbers on a couple of the other airlines, Delta, Alaska Airlines, but it all points to the strength of the airline industry as people are flying in planes again post COVID, at record amounts.
Yeah, like absolutely. Like you said, American, they reported 86 cents a share in earnings, beat by 20 cents, but they had worse than expected guidance in Q1. Delta, 85 in earnings, beat estimates of 74. Alaska doubled earnings expectations. They reported 97 cents a share in earnings. Expectations were 47 cents a share. And then they did guide to a first quarter loss, but better than expectations, which is where American fell short. The one big takeaway that I had with earnings, or the one thing that I'm maybe eyeing on this is there was some commentary that the general environment is fewer seats domestically. So that gives you lower costs, but allows you to raise prices. And I saw commentary that was pointing out that the conditions are very similar to what we saw between 2012 and 2014. In that period of time, airline stocks as a group were up about 300%. Um, it's kind of tough to just easily do back of the napkin math on these because a lot of these companies have gone through reorganizations, so you can't just like quickly Google and pull up something. But if we look at United, it was up 250% in that same period. So far in the last year, United's up like 128%. If these conditions that we've got now, assuming the economy stays pretty strong, are actually similar to the 2012 to 2014 period, we may only be halfway through the rally.
Yep.
The airlines could have a lot more room to run if we've got just less seats, people spending more on seats, less costs on maintenance, less deliveries. Like all of those sort of marginal costs are lower, but if there's still high demand for travel, and people are still spending money, then that's obviously great news for airlines. So that's a sector definitely to keep an eye on and maybe leg into it if even if you're concerned that hey, maybe it's run too far too fast. I think there is probably still room to run from.
Yeah, to your point, I mean, United and American at least are still cheap on a valuation basis, on price to earnings, price to sales, price to book basis. Historically cheap even after this run. You're trading at record highs in United's case. So I agree with you that the airline run might just be getting started. Okay, real quick before we welcome on Mike Larson, the market's breadth has expanded. That's one thing that's fueled the rally the last couple of weeks, or it's not just, a handful of growth stocks, Mag 7 stocks. And that makes it a good time to invest in, value and growth. And that's sort of what I try to do in Cabot Value Investor. That's my one of my two newsletters that I run. And today, for people interested, we're offering a discount for anyone who wants to sign up for Cabot Value Investor. You go to cabotwealth.com/street. Again, I sort of do a growth at value prices approach. Warren Buffett takes a similar approach. I'm not comparing myself to Warren Buffett, Brad, but we've had some success in the newsletter doing that. Maybe with an airline. I'm not going to give away the name, but if you go to, again, cabotwealth.com/street, you can sign up for Cabot Value Investor, monthly issues, weekly updates on all the stocks in the portfolio, free special reports, all that good stuff. So cabotwealth.com/street to sign up for Cabot Value Investor. Okay, let's take a pause and we'll welcome on Mike Larson of MoneyShow. All right, we welcome on Mike Larson, who is editor-in-chief at MoneyShow. Just a quick note, Brad's reception has gotten a little choppy, so it's possible Brad will cut out at some point. Hopefully not. Hopefully we can get through this together. But Mike, thanks for joining us. I'm glad you're joining us now and not, say, 2 weeks ago, 10 days ago, when the market, I don't know, bleak would have been too harsh a
Suspect.
word. Suspect. Yeah. I mean, there's a
Suspect. I
lot.
like it.
Yeah. I mean, we had over what, 300 stocks at 52-week lows, very few at 52-week highs. And that's almost completely flipped. It's like 50, it's down to like 50 at 52-week lows now. And I think more than double that, 52-week highs. Uh, I mean, is it just simple as inflation change? What has changed in the last couple of weeks in your mind?
Yeah, well, Chris, thanks for having me on here. Appreciate you having me on the show. I think it's a market that, you know, obviously the interest rate story is a key focus. And as part of that, of course, is inflation, right? I think, as we rolled into the year, I always joke I have a 3F rule when it comes to interest rates. They're not a problem unless they rise far enough, fast enough, and for long enough.
Mhm.
And I think what we saw by sort of the post-election move and even to some degree pre-election move in the 10-year in interest rates overall higher, they started accelerating and rose far enough that the market was having a hard time digesting that as we started 25. Expectations for Fed cuts were being rolled back. Long-term interest rates were up, and people were talking a lot about, okay, in a Trump administration, there's going to be benefits and so on, but there's also going to be issues with tariffs, pushing inflation and consumer prices up and so on. So I think the market had to wrestle with that. But more recently, in the last week or two, we've kind of started to find a home base. Tens, 4.5% to 5%, somewhere in that neighborhood. The dollar's eased off the big rally it was having as well. I think people in markets are trying to sort of understand, is it Trump tariff talk or is it, and bluster, or is this really going to be as aggressive as they're talking about? And there seems to be kind of a reevaluation of that maybe it won't be so bad. So as we take some of that tariff fear and inflation fear and interest rate fear and dollar fear out of the market, it's helped to give us this more recent leg up. So I think that's pretty much, as I see it, what's behind this more recent move.
Yeah, it seemed that the market definitely liked that, the fact that among his 30 plus executive orders on his first day, that none of them involved tariffs, as many had feared. And I think he said this morning, I don't know his exact words, but he seemed to be easing on the China tariff thing. Who knows what'll happen there? But so far, so good, and that's definitely contributed to the rally. Yeah, you mentioned, sort of the 4.5 to 4.6% range for interest rates, treasury yields. I had highlighted 4.5% as being sort of the magic number to drop below, but I think you're right that it's more about direction and momentum for where, like, they're not rising, steadily now like they were for much of December and the first couple of weeks of January. It seems like the market can rise even if yields hold steady for the next few weeks.
Yeah, it's again, it all goes back to sort of speed and magnitude. And
Yeah.
if you take some of that pressure off, then I think that people can refocus on other things, which is the regulatory policy, the fiscal policy, of how that's going to be different in a Trump 2.0 administration versus what we had in the Biden administration. And even if you go back to Trump 1.0, I mean, there was more volatility in the markets because we'd have days where we're up 300 points in the Dow because there's a trade deal with US and China. And then the next day you're down 300 points because the trade deal is off. So some of that stuff that comes with this administration that we saw the last time around, I think you have to expect as an investor this time around. But
Right.
ultimately, from a market standpoint, if it's more friendly regulatory policy and more expansionary policy overall, especially on the fiscal side, that's probably good for markets.
It sounds like I think the picture that you're painting is the market has sort of hit an equilibrium point right now that's sort of generally bullish, but that you see maybe headline risk as more elevated. Is that, let's not over the full 4 years of Trump's second term, but in the next 6 months, is the headline risk what your assessment is of the market, that's going to be sort of the dominant risk, or do you see maybe other structural issues? I mean, like interest rates aside.
Sure. I think, volatility, higher volatility in general, is going to be the name of the game here. I mean, we all know Trump speaks off the cuff, and we know that some of it that he throws out there is kind of to test market reaction, test world leaders, bluster overaction. Some of it ultimately does come through, but I think, those sort of tape bombs, I guess is the old fashioned terminology. You got to be ready for that as an investor. I think bigger picture, if I have to kind of put my hat on, look longer term and what would worry me, I think if this sort of steady market advance, this solid advance that does seem to be broadening out somewhat, if we were to not see more of that, not see more of non-tech sectors participating, things like financials, things like energy, things like industrials, and we are seeing that now. Let me put that out there. But if we don't continue to see that, and instead we just get this rip roaring boom in tech, a market that sort of throws off all its worries and just is going up, a couple of percentage points every few days, that sort of boom scenario, ironically enough, would actually be the thing that would worry me. So far, I'm
Yeah.
not seeing that. So far, yes, we had the best two back-to-back years for the S&P since 97, 98. But a lot of the stuff that worried me back in 2021, every day there's a new SPAC, every day there's a new money-losing IPO in the tech sector coming public, that sort of like dot-com-esque behavior.
Yeah.
I'm not seeing that yet. I think if we get to that point, that would worry me. But so far, it seems like a steady, bold type environment, and I think that that's worth positioning for as an investor.
Are there sectors in particular that you like for the upcoming year, at least upcoming, say, 6 months?
Yeah, sure. I mean, I think again, if I go back to what happened last July, July of 24, we had that sort of violent rotation where tech had been doing great, small caps were doing terrible, and we had a big dislocation in the market where I think when a week the Russell was up like 10%, tech was down, a lot of money did this big rotation. We retraced some of that post, in the third and fourth quarter, but we didn't entirely give that back. We saw small caps still doing fairly well at the tail end of the year. We saw sectors like financials really pick up the slack, utilities doing well. And as of a couple of days ago, energy was ironically enough the best performer year to date, with the caveat that it's only a couple of weeks into the year.
Right.
And that's sort of weird given that drill baby drill is supposed to be bad for, or boost supply and therefore depress pricing and hurt that sector. So you are seeing some of that rotation, some of that broadening out. And I think those are the kinds of places where, as an investor, you have to be looking more. I don't think tech hurts you, kills you, whatever in this year, but I do think, and some of our experts that we have at events have pointed this out. Things like financials are going to benefit from a greater, a better regulatory environment, less restrictions on credit and lending. Things like industrials are going to, and small caps are likely to benefit from nearshoring, onshoring, U.S. favorable regulations and tariff policy. So I think that all argues for, again, a market that's a little more smokestacker driven than just, AI stocks going up every day.
Yeah, I
Yeah,
mean, market breadth is what we like to see, and that's definitely been the something that's been a highlight of the last couple of weeks. Brad, you had something?
Yeah, I just, talking about sector specific performance, there was one thing leading up to this call that really resonated with me. Your Be Bold strategy. I was hoping you could talk more about that because, Chris and I did sort of financial New Year's resolutions, and one of my big ones was trust moves early, right? Which stood out to me as sort of my own take at boldness. But I want you to talk a little bit about your Be Bold strategy and how that's been working out for you.
Yeah, sure. I mean, really, since Money Show events at the beginning of 2023, I've talked about be bold as a simple, succinct way of summing up my market view. And basically, it means, in 2022 and even the year prior, your more boring stuff was tending to outperform. The market was kind of worried about recession risk, rising interest rates, some of these other things. You actually saw sectors like utilities, consumer staples, the stuff that tends to do well in a pre-recession or recessionary environment outperform. But that began to change in Q4 of 22, and especially after we rolled into 23, where you started to see the bolder stuff, the more economically sensitive or aggressive sectors and parts of the market outperform. And I think that, I saw enough at that time to basically shift my worldview to adapt that be bold thesis, which means, again, in kind of shorthand terms, position yourself in more aggressive sectors, growth sensitive sectors, things that do well in a growing economy versus an economy that's on the cusp of recession, and all the other things that flow from that. Buying things like gold and other precious metals. Looking for maybe bargains, especially more recently in some of these sectors that haven't performed, especially as we start this year. That's kind of the next leg that I see. And I don't see enough to change that strategy. I mean, again, I'm not a perma bull by any stretch of the word. There's been times in my career, I mean, I've been at this since the late 1990s, times when I've been sort of like shouting from the rooftops, hey, there's a lot of stupid stuff going on, a lot of excessive risk taking, a lot of danger signs in the market, and you really want to prepare yourself for downside. But I'm not seeing those kinds of things that worry me now, and I'm really not expecting them as the year goes forward. Again, I think the biggest worry for me would be if that generally bullish sentiment turns into kind of this exuberant sentiment, and you start to see some of the excesses in credit, excesses in IPOs and in other parts of the equity market that really signal you want to batten down the hatches.
That actually brings to mind two specific sectors that we've talked about a lot on this podcast that I've been using just as risk metrics, right? Like they're highly risk on, they're very aggressive. Space and quantum computing. So commercialized space exploration. I am curious how you sort those sort of booming-ish sectors into your or bold. If you don't have a strong opinion on either, that line too.
I'm not, a big niche guy that knows a lot about those spaces, pardon the pun, but I will say what worries me, you're always going to have pockets of the market that are seeing exuberance, pockets of the market that people are chasing things. I mean, obviously back in COVID, it was the meme stocks and all the craziness going on there. And throughout my career, there's different things. Uranium was the it place to be not too long ago, and so on. If it stays localized and stays kind of in a niche sector, and you have some silliness going on there, but it's not much more broad based, that's okay. I think that, again, that's markets. That's why we're all in this, to make profits and sometimes take aggressive positioning or make aggressive bets. What does concern me, again, just to kind of use the most recent example, is what I saw in 21, where it wasn't just one or two of these companies. There was a SPAC, a SPAC a day keeps the doctor away type of market, and just all these junk IPOs, money losing companies in the tech space coming public and then crashing 50, 60, 70%. So again, I don't see that yet, but that's what I'll be watching. There's always market niches that are going to do well, and that if you know enough about that space, or you have the right advisor or editor or so on who knows that space, great, you can make some money for a portion of your profit or your portfolio. But it's just when the broader, from a big picture kind of macro standpoint, it doesn't concern me unless it really starts to get out of hand and just spill over into the rest of the market.
Yeah, I think as we saw, I'm sure you experienced at MoneyShow,
Thanks.
2020, 2021 are great years for our industry, for investment newsletter publishing industry. The next time, if we set records this year for revenues by a mile, like in 2021, that might be a sign of a top. Just going from our anecdotal experience. But speaking of MoneyShow, you guys just released your annual top picks report. You can find it at toppicks.2025.moneyshow.com, where you take contributions from all over the industry, investment newsletter publishing industry, including Cabot. Just about all of our analysts contributed a couple picks for the upcoming year. Was there, I'm sure you've been presiding over that report for a while now. Was there a theme, without giving away any picks, obviously, was there a theme that stood out to you this year versus prior years?
Yeah, thanks for that. I mean, again, the report, it is available at toppicks2025.moneyshow.com. And yeah, I've been officially on board with Money Show for just 2.5 years now, but I've been presenting at their events all the way back to 2005 with my former company. So I've gotten to meet a lot of the publishers, a lot of the editors, analysts in this business. And I'm fortunate that every year I get to be part of this project. It's a big undertaking, going out there to all of our best analysts. And like you mentioned, we're fortunate, and thank you for Cabot's participation. Being able to go out there and say, look, give me one more aggressive idea, one more defensive, maybe income oriented idea that you'd recommend if you had to at the start of the year for the next 12 months. And the result is the top picks report. We have some contributors that are kind of in there every year. We have some new ones I try and work in based on who I see really has a good feel for the pulse of the market. And this year, it's 92 pages, it's more than 78 recommendations, and it's more than 44 contributors that have all thrown in ideas that are in their specialty. We have people that specialize in biotech. We have people that specialize in tech in general. We have a couple crypto focused people and a couple, income type oriented investors, or excuse me, editors. So it's a good mix of a little bit of everything. And I will say, what's kind of noteworthy about this year and about the picks in general, not everybody's going to come out and say buy Facebook, Microsoft, Google, whatever. I mean, you can get that anywhere, right? The idea is to find some, more off the beaten path type ideas, more contrarian type picks, in some cases, even small cap, not quite micro cap, but in that area, places that for, the riskier part of your portfolio, you can afford to throw some money at it. And what I found was a few different themes, sort of the AI theme, the GLP theme, the bull market in metals. There were different sort of groups of picks that kind of fit into that. Not just GLP drug producers, but companies that would benefit from the vanity trade one of our editors referred to, people caring more about how they look and what that means. Bull market in metals, obviously gold just hit an all-time high a couple months ago, and it looks like it's getting back to those levels now. So there's some junior mining companies that a few of the editors have picked. I've even seen, interestingly enough, a few picks in foreign companies that derive more revenue and earnings from overseas. That's been this whole story. The U.S. markets are the only place you want to be. You don't want to own emerging markets, foreign markets. But interestingly enough, there's a few companies, that are focused in those areas that people are looking at as bargain plays, as turnaround plays, as benefiting from the next step in the sort of market's evolution. So those are a few of the areas that have been interesting to see. And again, it just goes back to getting idea generation. You've got 70, 80, whatever picks. Take a look at them. Do your own research after reading what the editors have to say. And keep in mind, I always throw this out there, it's not a managed portfolio, right? I track how every stock does over the course of the year. I build a quote unquote portfolio in Yahoo Finance to track it. But these editors' opinions can change. So I always say, if you read the report, if you download it at the beginning of the year, subscribe to the newsletters in there. Some of them are free, some of them are paid, but at the very least, you're going to be able to see editor A may have loved stock X at the beginning of the year, but in 6 months, where are they at? If you follow the editor's work, you'll know whether that sort of thesis has changed over the course of the year.
Yeah, and again, that's a top picks 2025.moneyshow.com. I think I added an extra dot in there to start. Brad, any last questions for Mike before we let him go?
No, I'm going to defer to my weak connection and leave that
Okay.
there.
Yeah, you had there's just one little hiccup, but otherwise good. Mike, thanks for joining us. Glad you're joining with the market back at all-time highs. But like you said, not too frothy. Seems like a good time to be in the market.
Perfect. Glad to do it, Chris. Take care.
All right, take care, and we will see you next week on our latest episode of Street Check.